All right. Hey, everybody. We are now broadcasting on time. Thank you to SeedSpark for getting my audio driver reinstalled after it fried out from the updates the night before. Not a good thing right before you're ready to launch into a webinar, but we adapted and overcome. So thank you. Sometimes absence makes the heart grow fonder. Absence from an audio card makes me really appreciate having audio. So anyway, I wish we were going to have some great news about the Treasury Department and SBA making the priority of new guidance available for us, but evidently their priority timeline and ours is still different, but I still think we have stuff to talk about. Adam and Jack, you want to do a little preamble before we get into Q&As, and also just as a reminder to people as they're ramping on to this webinar, please use the Q&A button for any questions, and the chat is reserved only for harassment of the panelists. So Adam, you want to do any sort of preamble or thoughts on this before I pass it to Jack?
Yeah, and I'm thinking we probably should consider shifting gears a little bit next week to mix in some Main Street lending program information. So I'm going to start there, primarily because there have been a few changes in that program in terms of lowering the lending limits, but it is still very convoluted in terms of the restrictions of how you would obtain a loan. But we have started getting our first inquiries from clients about what we know about it and if we know if anybody's doing anything. Interestingly, received a text from a banker to be unnamed, but she knows who she is. That just said, "Hey, what do we know about it?" And my question back was, "Well, what is your bank going to get in the mix or not?" And I think the general feeling, we haven't heard of any banks that have really pursued heavily the Main Street lending program, because that is going to end up ultimately getting sourced through banks, just like the PPP program. And the response back that I got was, I think we've all got PPP fatigue, which probably a fair characterization. At the same time, it is a good source of debt that is backed by the Treasury Department, and that the Treasury Department is ultimately going to own the notes. So it's got the same effect as if it was SBA backed. I mean, there's probably some sort of legal something or other that sits behind that, but I think it probably behaves in principle very similarly to a bond, that, hey, if the government defaults, then you've got to default, but the government typically doesn't default. I just, again, I find it interesting that you haven't seen anybody out there aggressively pushing these things, because it seems like this would be right, and maybe they are, and we just don't know about it, but this seems right up the alley of like a Citi or a Chase or even a Bank of America or somebody like that to say, hey, I know we might have messed up over here, but look at where we can help out over here, especially to their customers that didn't qualify for PPP. So more to come, hopefully, on that sometime next week. But I just find it interesting.
Jack, any additional thoughts?
Yeah, so I'm also seeing a shift of, I shouldn't say shift, but inclusion of the Main Street program into the public discussion and internal discussions. And so I think that it's appropriate to incorporate that in our conversations. And so, Adam had alluded to some changes, and, some of them are, for example, that the maximum loan size has been increased, that principal payments are deferred for a longer period of time. I mean, some of the things that we see, and then minimum size is down to 250, and it was, I think, 500 to begin with. So those kind of changes are coming into play, which is understandable as they align that program to benefit more people. I think that the original intention was to create two sort of mutually exclusive buckets, and they're seeing how that they need to bring that mutual exclusivity line closer to each other, and potentially maybe even overlap in some instances. And so there's that. On the PPP side, The only things that I've seen that have come up in the past 48 hours or so are things that are not necessarily helpful to those who have already received their loan funding, which is I've seen a new borrower application. I've seen a new lender application that basically for the lenders to submit the loans to the SBA. And then one point of clarification that was clear is that this line of demarcation between being able to go from 2 years to 5 years, June 5th is the date. And so for those loans on or after June 5th, it's a 5-year program, five-year loan. For those prior to, it's still 2 years, but you can negotiate with or have a discussion with your bank and essentially revise the loan documents. You can have that, the benefit of the 5 years for those loans prior to June 5th. So, and then of course, they said formal guidance on changes are forthcoming from the SBA. And this is the SBA who made this statement about 48 hours ago. So that's kind of the extent of things that I know. There was a question about 501c6s in prior discussions, and that going back a little bit, the HEROES Act, which was that what Congress was talking about, and then the Flexibility Act pulled some things from the HEROES Act. So I don't know where the HEROES Act stands now, but within the HEROES Act, there was discussion and inclusion of expanding the benefit to other nonprofits other than C3s. And so I'm don't have much to report on that at all, really, because we haven't heard anything more about that, including where the HEROES Act is. At least I haven't. So I just wanted to update my reporting on that. That still nothing to share on that question.
So Robert has weighed in with a little bit more clarity on Main Street Lending Program. He said it's 95% Fed, 5% bank ownership, and the Fed hasn't opened it up yet with applications, and it can only be applied if PPP was not received. That's according to his understanding. So thanks, Robert, for passing that along. Again, as people are continuing to add on to this webinar, use the Q&A button, and we've got some in there already. I'm going to also read one that we got from Karen yesterday, and I told her I would put this on the webinar, even though we did pass it on to our FAQ expert desk that is focused on PPP right now and these kind of programs. And here's her question, or the scenario. I easily understood the maximum limitation on employees earning $100,000 per year to be $15,385. However, as I was processing my thoughts while listening to you on Tuesday, a situation popped into my head for which I needed clarity. If I use the APCP method on the last payroll, one employee who makes less than the $100,000 per year goes over the $15,385, do I need to back his paid salary down to $15,385? And so that was the question. So our response was, be conservative. Don't include more than the $15,385 for any employee at this point. Any additional thoughts on that, Adam? Or
well, when there are a couple moving parts there. One is, this gets to the $100,000 limitation, and should you pay anybody more than $100,000, regardless of whether it's $15,385 is the number that you use, or if they expand that to be over a 24-week period, which would be the $46,000 number or whatever it is. That's really up to how you plan on deploying the funds. I mean, the only thing that matters is that if you spend over $100,000 on a person, then that's still a payroll cost to you. It's just not something that you can apply for forgiveness for. And since people making over 100 grand was included in your application, meaning you back them down, in theory, you wouldn't have received the money to fund over 100 grand in the first place. So I feel like in all these cases where you're about to go over the $100,000 limitation, the only reason to ever even consider even doing anything associated with the employee would be, if you were bumping up against, hey, nothing's going to be forgiven, or I'm going to miss out on some forgiveness because I'm doing it. All that said, Gary, again, is a way better culture guy than I am. And I oftentimes have been accused of having a self-righteous anger. Thus, my self-righteous anger, if I was that employee, would be like, what you can imagine what the first part of the swear is, followed by you. So I just, I'd be careful on that. And then after Jack weighs in, I got something on the Main Street lending program to clarify as well.
No, I think you said it all sufficiently. So I will take a pass on that one, other than, the mathematics of it. Again, it's, you and I, as we hear this, we're going through it and we're kind of trying to do math in our head. So I'll just say that, what we say again is kind of general guidance in that, do the math on paper or do the math in an Excel spreadsheet just to make sure you got it right. So,
yeah. So going back to Robert's comments, I love you, Robert. Everything that I've seen is that you actually can be in both loans at the same time, because the Main Street lending program was supposed to be an alternative source of credit for people who otherwise was having credit dry up, which, makes sense, because a lot of the stuff that we're starting to see out of banks now in terms of, and again, I love all our banking partners, but if they're going to be the ones that have 100% of the risk associated with the performance of a loan, and they're expected to continue to loan to help prop up the economy, it's like, geez, that's kind of hard to say that, I know that I'm doing what's great for America maybe, but it's hard for me to say, am I really protecting the long-term interests of the investors if I'm making loans to people that otherwise I don't have certainty, can repay me, and my collateral base has deteriorated in terms of quality just based on, the unknowns in the economy. So, it is, in all fairness, I mean, I know I can get self-righteous again when it comes to our banking partners, but in some respects, I can't really blame them on this. I mean, if I was the one that was having to loan the money out and I wasn't kind of like something, hey man, I can really use the money, I think it's going to be good, in the future, but I can't really tell you today. And, and I actually need more money than, even though I have a sales decline, it's like, you have all these bad facts that in any other environment, a bank would say, no, to, we're wanting them to say yes. So you would just feel like, hey, something has to give for the bank to then free up money, which is why the Main Street lending program was put into place. But they also wanted to have it be an avenue that didn't require a law to be passed, which is why it's in the purview of the Federal Reserve system, instead of having to be something that's done by law that requires an appropriation of funds.
Yeah, and I would say, just as a a matter of perspective, I've said this before, the target audiences are meant to be different, but there are ones that are going to be in both camps, certain companies. I mean, as far as how much loan proceeds you're asking for. So imagine it from this perspective, which is, you have kind of, if the normal regulations with lending in relation to SBA or government-backed programs or government-involved programs is like this, really tight. And then the analogy would be that PPP kind of opened it up so it's not as tight. And then you have kind of EIDL here, and then you kind of have Main Street here. And that's with respect to credit risk, with respect to collateral, and all those other things that go into a decision of lending. And so that's the way I look at it, as, as far as risk and risk tolerance, as them being the same kind of set of rules, but the level of openness or reduction of restriction is within like these concentric circles. versus, the amount of money that's being potentially loaned to. So
Yeah, I think that's a good way to think about it, Jack.
All right, if you guys are ready to lock and load, I'm going to rock and roll with some of these questions. So here's the first one. I'm 7 weeks into my original PPP period. I haven't spent anything yet. I'd like to use the PPP funds now that the Flexibility Act is passed, but I can only afford to use them for 8 weeks as I cannot afford to pay anyone for 24 weeks right now, including myself. Do I have the option of selecting another 8-week period, or can I wait to rehire until the final 8 weeks before the expiration of the 24 weeks? Thanks.
Well, the whole point of the expansion of the 24 weeks was to go ahead and allow you some more time to figure out how you're going to deploy the funds. So, if you have 24 weeks right now and you're not at the point where you can deploy the funds, you could at least, maybe start using some of them, at this point, because you have to assume that when you say I can't afford to use the money, then that implies that at some point, if you try to wait, that would imply that you're waiting to open back up, which means you're going to have revenue to offset some of your expenses. So hopefully at some point you'd have the ability to go ahead and deploy the money.
All right, next question. Hey, Vicky, I've worked on 2 PPP loans that went to 2 different banks. Now that forgiveness is extended to 24 weeks, we're not hearing anything from the banks about potential time frame or accepting forgiveness applications. I'm assuming they're not doing anything until further guidance comes out. Have you all heard anything from your bank contacts about what their plans are?
I think it's, probably a safe assumption that based on the new law coming into effect, that they're going to delay taking any applications for a few weeks, even though you have the ability to go ahead and submit.
yeah, you probably end up in their queue and just in a stasis period for now, if you're allowed to or permitted to submit those applications into those systems.
Yeah, and if you think about logistically, I think the challenge that you get into, if you think about the application process, how many of our clients ended up having to resubmit based on a change in the form? I mean, even if I filled out all the stuff now, I go through the process of getting ready, I think, but in terms of like producing the schedules on the actual application form itself, I just feel like that might be redundant work, because even if it all appears exactly the same, just the fact that there's a new revision number, that's going to come out probably means the bank would ask you to resubmit it anyway on the new format, even if it hasn't freaking materially changed, which would also make my self-righteous anger crop up. So I would just soon rather avoid that by not doing unnecessary work.
All right, next question is a scenario here. The client is in construction, hasn't been able to keep up its FTE numbers due to the weather. So they would pay the workers if the weather was cooperating. Is there any relief for these kind of situations, or is there the only option to use the 24-week period to get their average weekly hours up?
I think you're stuck on just the 24-week period, because the weather is unrelated to COVID. I mean, you would have had weather problems regardless of whether there was COVID or not. So that, I think you're stuck with, if you're trying to get forgiveness and not have debt at the end, it's 24 weeks for you to try to clear out your backlog, assuming that you have it, because the weather is the weather. Like, there hasn't been any hey, we gave you all this money. And I'm sorry, I'm not trying to trivialize this. It's a real issue, but if you think about it from the government's perspective, hey, we gave you all this money to keep people employed due to a pandemic, and it rained a lot. That's not, I think, a scenario where they're going to say, hey, because it's been a rainy season, especially, since we're canceling all these regulations associated with the EPA and anything else associated with global warming. Oh, sorry, I got out there. Gary's gonna get mad at me about that. That was my funny reference for a second. But yeah, I just don't see him doing much around the weather-related delays.
I think it's hard to what is inclusive in a a force majeure where there's something act of God like rain. I mean, what about the rain causing a power outage that lasts for several days, so you can't have people on the job for that? So I mean, there's all kinds of, I think, extensions of circumstances that I don't think were intended to be covered, and even if they were, it becomes, I think, a logistic nightmare as to, okay, it rained in South Charlotte, but not North Charlotte, and, job by job. And I just think it seems like it would become unduly or unwieldy effort in trying to get all that covered, and differentiation between is it or included or not included.
Okay, so I'm just going to make this editorial comment before we go into the next question is like, do y'all see what I have to work with every day here? Do you understand what I'm having to deal with?
It's like BPC, no.
Oh my goodness, pray for me. So the next question is, the covered period seems to be either 8 weeks or 24 weeks, not anything in between. Is that your read? Many clients can easily spend their PPP money, but may not have the funds to keep FTE numbers up long-term, like 24 weeks.
I think we read that as up to 24 weeks, not one or the other. What was your take on it, Jack?
Yeah, I think so. And I was looking as I was thinking about that, because there's been a few questions as to what that means. I think it's a 24-week period. I think that is the end point, but I'll continue to look and see if in what I have, if there is a clarification on that. But regardless, I think that is going to have to be, again, clarified even further as to what they mean, because I haven't seen necessarily an explanation other than if the loan is prior to June 5th. I think June 5th, because that's when the Flexibility Act passed, is a key point and stitch in time as to a lot of things right now. And so, can you, do you have the option of an 8-week, 24-week? Is it something in between the two? I don't know if we know that yet.
Yeah, there's a lot of question about that very topic. So Nazarene, I think we answered the first question, which you basically duplicated what somebody else had. So you're in good company. You're not alone. And then I'm going to go ahead and read part of Nazarene's second question, wondering if it was either or. And he wanted to choose the 24 weeks, so here's the scenario. Do I need to be at the full employee level for the full 24 weeks or at the end of it? We're currently at our full employee level coming up on the end of our 8-week period, but we will lose 2 employees. Can't afford to keep them on before the end of the 24-week period. I want to be able to get full forgiveness on the full amount, if at all possible.
Well, you have 2 components there. So again, we don't know definitively, is it one or the other? My assumption, which could change tomorrow, is that it's we're giving you up to 24 weeks to use the money. And, Jack's flipping it now, unless you find something contrary in this next 10 minutes. So that being said, Nazarene, I think you're falling in the bucket of, hey, I'd like to do early forgiveness because I otherwise have all systems go. Let's get this done and behind me. And I don't want to be penalized because I waited. I'm going to guess that you're going to have the ability to control the dates that you're asking for your forgiveness period of, on the assumption that it's a up to 24-week scenario. So I would think you might not be harmed. But even then, even if you're stuck on the 24-week scenario, remember that under the new Flexibility Act, I would assume that you're not replacing the positions because the business can't support the positions. And that is an allowable reason to not hit your FTE count. So they're not, it was originally, the guidance was we kind of don't give a shit what your revenue is. You need to hire people back. Unless they give you a written rejection of the offer, then you got to take away their unemployment. But the new Flexibility Act basically says, look, we get it. Some people are going to have kind of a permanent decline or will not have recovered yet. You don't need to replace those jobs for the sake of replacing those jobs. If you otherwise couldn't support them financially because of a revenue decline. So that, I think in either case, you probably are going to be in good shape, Master.
All right, great. Thanks. This is another question along that same line. Since the timeline was extended to 24 weeks, may we use the PPP money and get forgiveness for pay for our employees' payroll, those that make less than $100,000 a year, for more than 8 weeks?
We don't know. That's one where we don't know. Is it going to be at 15,385 or is it going to go indexed week by week? So we don't know yet.
Yeah, the number that I've seen, I guess, is just taking that number multiplied by 3 is 46,154. Sounds right, 15 times 3-ish, or 15-ish times 3, but because the period has been extended by a multiple of 3. So, don't know yet. That hasn't been addressed. It's acknowledged as an open-ended issue that will need to be addressed. And looking at the 8-week and the 24-week period, it's referred to different ways, but the most common way I've seen it referred to is the time to use the loan proceeds. So it seems to me that it is an extension of, it's not either or. It seems that you're taking a period that was set and saying, okay, if you weren't able to use the money within that 8-week period, then we're going to allow you an additional time period, basically 200%, 300% more, well, an increase by 3 to use that pool of money. Now, then you get into, well, the allocations of different people. So is it still 100,000? So is it 15 or is it something different? And so we just don't know, similar to where we were in other times during this process. We just don't know the formulas and the math and the modifications. We know what it is currently or what it was prior to the changes, but we just don't know what the modifications and the morphing of the math is going to be in all instances.
The good news is they said it's going to be a priority to issue new guidance. Stay tuned.
Yeah, I know that logically it makes sense. You would just take $15,000 divided by 3 to get to, hey, this will probably be the new maximum forgiveness amount. They report. The only thing that I am concerned about that is that basically means you can pay less people more money, which seems a little bit contrary to what the original intent is, which is to, use you as the platform for keeping people employed by giving you free money. So that would just be more money to less people in that scenario. So that's why it makes logical sense to say multiply it by 3, but I'm also concerned that they may say, nah, it's still 15,385. We were just giving you more of a window of opportunity. Basically, the way I'm looking at it is that, hey, we get it. It was going to be hard to spend the money in 8 weeks. Therefore, we're extending it to 24 weeks, not because we want you to spend the money over 24 weeks because you're not hard to spend it now. I think it's more like, instead of having to start here, we're going to allow you to start here. Now, they haven't said that, but I think that was the original thought. If I'm getting into a legislature's head, which is probably very dangerous, that's how I would think about it, is that, hey, we want to delay the start point for you. And the easiest way to delay the start point is just to extend the time period.
Yeah, and it has other ripple effects too. So you start talking about, not reducing any person's salary more than 25%. So now you have, so what happens in that instance that you're paying, it has a dilutive effect because it's a finite amount of money and you're manipulating both the rate of distribution and the amount of distribution per person potentially. So it's a lot of math, but we just don't know the formula to plug the numbers into in order to get to the appropriate result yet.
Next up is from Ron. My PPP was funded on June 2nd. Should I get in touch with PayPal or wait for them to get in touch with me with regards to the Flexibility Act?
I probably would wait because if you try to reach out now, the likelihood that someone's actually going to have anything to tell you other than we'll get in touch is probably pretty limited.
That makes sense. Next question is a scenario. You said on an earlier webinar that if business activities and revenues are reduced to the point where we cannot justify bringing back all the FTEs, our forgiveness levels won't be reduced. Our revenues have dropped to literally zero due to COVID. However, I'm not sure I can find specific CDC regulations that say we cannot operate. My understanding from Tuesday's webinar is that you could hire back less than your full workforce if you could show your business revenue had been dropped significantly. Looking at other resources, it seems to say you can only claim that exemption if you show you were prohibited from opening up specifically due to regulations. Can you clarify?
I haven't seen anything about prohibited from opening specifically due to regulations, but I also have not done a lot of digging into that. So Jack, if you know something more about that, please chime in. But where I've taken my interpretation is if you look at the employee retention credit, the way the employee, which is the closest thing to what does it mean to be disrupted? Well, there it's a gross receipts test. So basically, the first quarter that you had a massive decline in gross receipts, you were considered impacted and can qualify for the credit. And then you stopped qualifying for the credit once your gross receipts were restored back to historic levels. But in that whole time period, you could take the credit. I feel like this would probably operate very similarly, that regardless of the reason that your sales are down, because like even with a restaurant can open back up, but they can only open up at 50% capacity. And again, at Flatiron, near and dear, close to home, they're a client, thought that they would get really interesting and convert a parking lot into, it was covered. I didn't want to sit out there, no offense guys, but it was covered parking lot. They thought they'd convert that into excess capacity such that they would have 100% of what their original in-room dining capacity was. And, the health department said, or whoever said, oh, nay, it's 50%, period. That's all you can see. You can't get cued in terms of trying to expand your square footage. So my point in saying that is, I think, proving prohibited from opening, that may be something that's out there. I don't know of it, but I think I would think it's going to be more of a gross receipts. Hey, I could open, but people still aren't coming back due to other reasons.
Yeah, I would say that I don't recall us linking, and I think there may be some concepts that are kind of being meshed together to get from point A to point B to point C from our discussions, but I don't remember us talking about that if merely because the business activities and revenues are reduced, that forgiveness levels won't be reduced. We talked about how, okay, if there is an impact on you asking employees to come back and they don't come back. And so we had been talking about for a couple of weeks now, the concept of offer, rejection, and that rejection not having an impact on your employee count. Then we also talked about an extension of that conceptually, which is if there is an economic impact on the business, but it was in relation to employee count in the sense that, okay, again, offer being made, but it became more of an environmental issue that people were not coming to the business or employees weren't coming back. So that, it still is linked to, I think, the concept of why the cause being that the business hasn't increased and the revenues haven't gotten back to where you want them to be or where you expected them to be. But I think it's still linked back primarily to employee count issues, and not necessarily the fact that there isn't the revenue that was generated. I think that concept was important also when we were talking weeks ago about, before this $2 million number came about, that how do you prove necessity? And how do you prove necessity in the past when you applied for the loan? And then at the time before the $2 million line was drawn, that how do you prove it after the fact? Like, what is your reality? And so I think that maybe some of those, again, concepts have gotten meshed together. So I would focus on the employee count issue and the reasons for employees not necessarily coming back under that second prong of that employee count FTE exception that now exists, that wasn't there prior to the Flexibility Act. And I hope I'm answering that question and not missing what the actual question is.
Yeah, that is where it's relevant. It's not like they're saying, hey, you can have the money now, even though you couldn't use it. What they're saying is, if you still spent the money, you're not subject to the FT count restriction. You can have an exception if you spent the money, but your head count still isn't back at the test period because of other disruptions that occurred in your business, as another exception that could exist. Presumably these would be some COVID related. It's just that you can't make a one-to-one correlation between the government specifically shut down my business and this reduction. If you go back to the construction company examples, if I was in the new home construction business and builders aren't doing spec homes anymore because nobody's buying them, I'm impacted. But there wasn't a government regulation that made that impact.
All right, great. Next one's up from Jim. I believe we can reduce an individual salary by 25% without penalty in terms of loan forgiveness. What is the effect if an individual salary is reduced by more than 25%?
It's a reduction of your payroll costs before applying other criteria. It's the middle. If you look at the application for forgiveness, knowing that it'll change, it's the middle section of that application for forgiveness. Talks about the reduction of costs associated with people that hadn't had their salaries restored.
All right, next question's up from Robert. As an independent contractor or a sole proprietor with no employees, now that we have an extension to 12/31, are we restricted to 850 seconds of 2019 net profit as payroll forgiveness portion, or has that been expanded to 24 weeks or 24 divided by 52 weeks?
I think whatever the guidance is for in general is going to be the same guidance for sole proprietors, which is it 15,385? I mean, that's the round number, assuming you made 100 grand, or is it 46? So multiply it times 3. And the honest answer is we just don't know. There's a case for both.
We have rocked it through all of the questions so far, so we still have some time if anybody else has any questions for these guys. Speak now or raise your hand through the Q&A button, or forever hold your peace until next Tuesday. You can also reach us on FAQ@trustbgw.com. Just send an email there if you've got specific questions that you want answers for before we are back live on Tuesday morning. Provided I've got Wi-Fi service at the beach where I'm going to, I'll be here too with these guys. Hey, here's another question. If I choose the 24-week period and rehire 2 employees for the full week and the 3 remaining for the final 8 weeks, can I achieve full forgiveness?
So the first test, whether it's 8 or 24 weeks, is going to be an average. So assuming that you failed the average, assuming that the count is correct at the end of the period, then you'd fall under the exception of having rehired, assuming that you didn't need to use any of the other exceptions.
All right. Next question is, if I received the loan on 5/1 and I'm on track to use the payroll portion of the 8 weeks, am I still able to be forgiven for all the other expenses for the 24 weeks? If so, does that mean that I would close the loan forgiveness period once all of my utility expenses are paid out?
I think in that case, I would apply for forgiveness once I'd fully used the loan, in which case your payroll to other cost ratio might be a little bit higher. So I don't, the maximum amount, remember, is still the principal amount of the loan. So if you receive, $500,000, $500,000, whether it's 60/40, 75/25, 90/10, it doesn't matter. It's still 500 grand. So I probably would be looking at, as soon as my 500 grand was exhausted, that's when I'm going to go for my forgiveness.
All right. So this is from Andy. I'm not familiar with Main Street lending program that you're referring to. I'll Google it, but if you have a synopsis, that would be appreciated.
Yeah. So I'm going to try to wing this one, Jack, and then I'm going to ask you to chime in.
Okay.
So in the original CARES Act, the first section of the CARES Act really dealt with the Paycheck Protection Program and loan forgiveness and all that, hooly-balooly. The last section dealt with the credits that were available. The middle section basically was, hey, and we also recognize there's going to be some other people out there that need some money. So we're going to create this Main Street lending program. And off the top of my head, I mean, it was only, maybe 2 paragraphs out of the entirety of the act. That's off the top of my head. So that was it. Didn't hear anything about it. News is going to be pending, blah, 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 blah. Maybe 4 weeks ago or so, I'm losing track of time because we're on coronavirus time. For all I know, it could have been 2 years ago. But I think it was about 4 weeks ago, probably. The Federal Reserve came out and said, hey, we're ready to launch this program, and released its initial pass at the criteria, which really was around, one, company size. So there were some company size restrictions. The second was there was also some dollar value restrictions in terms of the loans, and also some repayment criteria. And then also, very similar to PPP and the EIDL loan, it was supposed to be, an additional, government-backed source of credit, not a bank suddenly saying, hey, that $1 million line that you had, that's gone, and we're going to replace it with this. So it wasn't meant to be replacement financing for financing that you already had. It was supposed to be financing that augmented financing that you already had. And then it was crickets because people were still in PPP land. So then, in the last couple weeks, they've made some revisions. It's probably even the last week, not even a couple weeks. They made some revisions to the program to change some of the criteria to make it a little bit easier, meaning broaden the range of companies that would otherwise qualify based on the loan size. But independent of that, it's still been crickets in terms of, having the ability to apply for and obtain one of those loans, because it's supposed to be, administered through a bank. But the reason it's government backed, air quotes, is that effectively, it's going to behave very similarly to Freddie Mac and Fannie Mae in the housing market, meaning that, the government, the reserve, the Federal Reserve is basically creating a special purpose entity that will, back or otherwise purchase. I can't remember, mechanically how it happens. All of these loans, such that the bank's exposure is pretty de minimis, very similarly to the way a government-backed mortgage, the bank's exposure is very limited, or an SBA loan, the government's exposure is very limited. or sorry, the bank's exposure is very limited.
Wow, that was pretty good. From memory, I was fully prepared to cheat off of an article that was published in the Electronic Business Journal that'll probably come out on Friday in the paper print. But just to kind of supplement all of that information with a little bit more specificity. So the program first announced, and I'm going to read just to make sure I get it right. It was part of the 2.3 trillion package of loan and bond initiatives. As I said before, it has lower limits, minimum size of the loan down from 500 to 250. It is the length of time for the loan is 5 years instead of 4. The numbers are, I mean, other numbers that are higher for that. But to Adam's point, the statement that's made here is the Main Street Lending Program is funded in part by the $75 billion from the CARES Act as part of the $454 billion, and that the money bolsters the Fed's ability to add credit to the existing monetary system, thus increasing the overall amounts of dollars available to lend while fueling a slate of new programs meant to combat the economic damage caused by COVID-19 and social distancing measures put in place in recent months across the country. It allows banks to lend more to their customers, et cetera. And then also it expanded, as Adam said, to include other things that weren't in there: airports, public transit systems, and other public or quasi-public entities that were not originally included in there. So, I think we've said that we'll put a little more focus on that in future discussions, but that's kind of the backbone of it. And there's plenty of articles out there, including on the SBA website, that discuss this in more detail. And speaking of the SBA website, Adam and Gary had shared an email link that with me on the SBA website that also has the PPP report as far as statistics go. I think it's probably several days old as far as the data goes when it was published, but it's interesting if you're interested in trivia as to how things are going and numbers go, that's something that you can take a look at as well.
Yeah, if I remember right, it said that there was still 130 billion available in that.
Yes, you are correct.
I don't have a steel trap memory like Adam, but he's 12 years younger than me, so I'm going to use the age as an excuse.
Yeah. But I got to tell you, I've killed about 4,000 times the number of brain cells that you killed, Gary. So that's just really no excuse. So my mental age is more like about 80.
Okay, well, we've had some more questions come in, so I'm going to read this one. Okay to spend the entire loan amount on payroll, even if no increase in FTE, for example, up to 25%, then change to 40% on non-payroll, but not required?
Yeah, I mean, again, the whole point was it's called the Paycheck Protection Program. So the more you spend on pay, it's not like you get a gold medal, but the more you spend on payroll, probably the better.
All right, next question is, obviously there's a lot of details to the PPP and it's continued to change. However, can you recommend a link or a site that has some kind of summary of the main items, maybe a bullet list, et cetera?
About what's changed? You could probably, I think you had sent out Jack's grid, and then there's also that grid that you sent out earlier from the law firm, the other law firm that is somewhere not here. So not Jack's competitor.
Yeah.
It was pretty good.
Okay.
Yeah, so
Like
if somebody wants and they have not been receiving any of those emails, but you're on this webinar, just send me an email at gfrey@trustbgw.com. Again, gfrey@trustbgw.com. And I'll forward some of the stuff that we've been sending out. So hopefully that'll help. Next one's up from Scott. I may have missed this, but are there any local lenders that have signed up for the Main Street Lending Program that you know of?
Not that I know of.
Yeah, I don't know either as far as signing up for the program. I think there's interest in participating, but as far as creating that conduit to get from applicant into the system, I'm not aware of any.
Yeah, hopefully Scott will have some more information by Tuesday, because we're in pretty regular conversations throughout every day. It seems like less frequently now than we were a few weeks ago, but still, we're still talking to a lot of commercial bankers and that sort of thing. So I know they were just getting long in the tooth on any more applications, even though there's supposedly 130 billion bucks left in that PPP program. But I do know that Cabbage with a K has still been taking applications, and I think PayPal has been too, based on some of the stuff I've been hearing. So stay tuned for more on that. Do you know any banks that have already taken loan forgiveness applications for PPP?
No, because the first applications would have just been coming up. So no, I haven't.
Yeah, and if we want to talk about, I was looking, and I have something else that I want to share going back to the employee count, but also that once the timing of once it happens has been established. So my understanding is the lender has up to, once the borrower does submit the forgiveness application, lender has 60 days to determine eligibility for forgiveness. And then the lender reports its decision to the SBA, and then will report the decision to the borrower, and then the borrower will have 30 days from the notice of denial, if it occurs, to request that the SBA review the lender's decision. So the process has been put in place. It's just that we don't know where we don't have a starting gate yet that has been opened up.
So I know that we've answered this earlier in the webinar. Somebody probably came in a little bit late, but can we use more than 8 weeks of payroll towards the PPP forgiveness?
I mean, you've got up to 24 weeks to spend the money. Whether you can use the equivalent of more than 8 weeks, we don't know yet. In other words, I guess let me clarify on that. Can you use, what we don't really know yet is, can you use more than $15,385 per employee? That's the key piece that we don't know.
And guys, if I could go back to a few minutes ago when we're talking about penalties or lack of penalties for employee count, I'll just read the original point of that, or a bullet point of that was the borrower documents inability to rehire an employee who was employed prior to February of this year, and further documents in its inability to hire a similarly qualified individual. So then we started talking about, okay, offer, rejection, reasons for rejection, if they will share that with you. And that was it. And then they added borrow documents inability to return to the same level of business as it had prior to February 15th of this year due to compliance with worker and customer social distancing, which is, from my perspective, subjective, sanitation or safety guidance or requirements. And the way the sentence reads is that is all of what I just said: worker and customer social distancing, sanitation or safety guidance or requirements issued by the U.S. Department of Health and Human Services, so HHS, the CDC, or OSHA, between March 1st and December 31st. So, it's what is unclear there, the way this is structured is, okay, does it have to be an official pronouncement, or is there more subjectivity in that? So going back to what we've said for many weeks now, which is documentation with specificity as to the reasons why you don't have your employee count up to where it might or should be in order to avoid a penalty. So, but now you have, as I said, the two prongs of that. And I would imagine that the applications will be modified to reflect that the forgiveness application will be modified to reflect those two bullet points that I just stated.
Also, I don't have this in the chat, so I can't necessarily forward this to you, but there was a press release from the Fed on Main Street Lending Program, and we'll have more information on that we'll start distributing next week. But if you go to federalreserve.gov/news events/press releases/monetary 2006-08A.htm, that will show what that is. So that's obviously the 8th of June that released. So federalreserve.gov. Doesn't look like we have any other questions. So speak now or forever hold your peace until Tuesday, or you can send us the FAQ. Also, anybody that came in late on this thing, if you missed something early on, we will post this on the BGW YouTube channel, but it's BGW CPA because there are evidently other BGW YouTube things out there, and I cannot guarantee how appropriate that content will be. So go to the BGW CPA YouTube channel, and we'll have this up later on today. Jack, thank you so much for being with us. It's amazing to have you on this many times. I can't believe that we've been doing it this long. Adam, thank you again. Your Rain Man photographic memory still amazes me. So thank you for doing what you do on this. And we appreciate everybody that took time out of their day to join us. Hope you have a wonderful rest of the week, and we'll talk to you on the same bat channel next Tuesday. You guys,
thank you. Thanks, Jack.
Bye-bye.